Hi, good morning. This is Manas Dalai from Investsphere Wealth. Today I'll discuss about why people are not getting good return in mutual fund. There are a lot of investors, they get different investment returns. You need to know why people used to lose money in the market. Why one investor is getting more, why one investor is getting less returns. It may happen that difference of opinion in the market of different advisors, right? So today we are going to talk about how you can minimize the risk and how you can maximize the profit. At the same time, when, which fund, which strategy, which mutual fund company to choose is the right, what is the right approach to invest in mutual fund to get maximum wealth over a period of time. First tip is not doing enough research. So there are a lot of funds in the market, right? So advisor or maybe your mutual fund distributor can talk about different mutual funds based on their suggestions, based on their income, based on their priorities. But as an investor, you need to understand what is the returns, what is the past few years track record of that particular fund manager or that particular fund, what are the objectives of that fund, what kind of research you are doing, like what are the stocks they are buying in that particular portfolio. Is it a large cap based portfolio based on your risk profile, whether it is well aligned or not? So you need to know all these things. So to know all these things, you need to have a person, the distributor who is along with you, or a private banker or a wealth manager or a mutual fund advisor. You need to sit with them and then discuss all these pointers so that you will not do that particular mistake. The second tip I have experienced in the last 2 decades of work experience in the different corporate is like investors are depending on heavily the past performance. They read past performance. If the past performance is good, they jump ahead and invest in that particular fund. So I think this is not the only one criteria you should look for. So past history doesn't ensure that you will be getting similar kind of returns in next few years. It may be depending upon a lot of factors like the fund manager's alpha. If you talk about fund manager's track record, you need to understand who is the fund manager, who is that person who is behind this particular fund, why that fund is going to perform, if the strategy, if the stock selection is right as per the market condition. There are a lot of buzz in the market. If the fund manager is not aligning those stocks as per the overall objective of that particular fund, you may not get that kind of returns in future. Hence, it is advised, from our end, Investsphere Wealth, we have a dedicated team, those who are doing research, those who are meeting different fund managers in different forum. They used to ask a lot of questions to fund manager. What are the changes happening in that particular fund? Why this fund is going to perform for next 2 to 3 years or 5 years? What is the what is the CAG return they are expecting? What is the PAT growth of those companies, those who are inside that particular mutual fund? We need to understand, and after we understand, then we come back to the investors saying that these are the funds which we can go ahead with for a couple of years. The third mistake which investors make is not diversifying their asset class. I'm not talking about diversifying in mutual funds. Like I have seen a lot of portfolios where 50, 100 mutual fund, different mutual fund company name and strategies are there in the portfolio. But that is not the diversification. I'm talking about diversification in terms of asset allocation. Let's say today, if market is not performing, then probably gold or silver is going to perform, or maybe commodity stocks will perform. If banking is not performing, probably manufacturing will perform, or technology will perform, or pharma will perform. It all depends, how, where you need to allocate the funds. If it is well diversified means asset allocation I'm talking about. So one asset is equity, the other asset is, let's say, arbitrage, the third asset is gold and silver, which is commodity, the fourth asset is maybe debt fund like government bond, government securities. So what will be the percentage based on your risk analysis, risk appetite? If one investor sitting at age of, let's say, 30 or 40, he may have more risk taking ability, capability to go for higher equity, lesser debt. But a person who is at 60 or 70 or 80, they may not choose that 70-80% equity. They may choose 70%, 80% into debt funds or gold and silver, and lesser on equity side, so that the proper mix of your asset allocation can help you generating wealth over a period of time. So even if your wealth is growing at 12 to 14% returns, or maybe 15% returns, if it is 15%, every 5 years your money is getting double, which is double than your FDs. FD return, tax-free FD is giving you close to 5%, right? And if you put those money in a proper asset allocator fund, then probably you are only getting, let's say, 12 to 14%. Still your money is getting double in 5 to 6 years. So 6 years double money, not bad. But at the same time, when market dips down, goes down, you should not be worried about, because if market goes down by 10% or 20%, your fund may be down by 2 to 3%. So volatility is all under control. So you should not be worried about the volatility, which is very, very high, and you are not able to respond, or you are not able to digest. So it is always good to diversify your assets. I'm talking about asset allocation, not in funds. Again, I'm repeating, there are a lot of investors, those who have diversified over a 20, 30, 40 mutual fund companies, 40 mutual fund schemes. That means you are over diversifying. So over diversifying also will dilute your returns. So we suggest 5 to 10 mutual fund is enough. 4 to 5 fund manager in a family is enough to manage. But you need to choose the best and the upcoming performing mutual funds. Fourth mistake is again my experience. People used to talk about, let's wait and watch. Let's wait, when market will fall, I'll go ahead and invest. I have a lot of money, but I'll invest when market is down by 10%, down by 20%. I am expecting a crash in the market. I don't know why. But nobody in the world have actually timed the market and got the maximum returns out of it. It is not possible. Second, there are a lot of people saying that, boss, market is all time high, let's not invest today. But if you see for the last 30-40 years in the market, in 30 years record, you'll never find a peak and which is not beaten by the market itself. So every peak, if you talk about 50,000, 40,000, 30,000, I've seen market at 8,000 level. So from 8,000 till 77,000, 78,000, in Sensex is a huge journey. But over a period of 15-16 years, this is happening, right? And for next 20 years, 30 years, if you talk about, the market will go up. It's like market will definitely go up. Thoda bahut fluctuations aata hai. If you talk about volatility in the portfolio will be there, but that doesn't mean that I'll be waiting for a particular correction and then I'll be investing. You are not investing in a particular stocks, or you are not investing in 4 or 5 stocks or 10 stocks where you'll be waiting for the opportunity. So it's a mutual fund. Even if you're not investing in a mutual fund, but somebody else is investing, still your NAV is getting averaged out. So you are getting the benefit if it is going down. So when it is down, there are a lot of people, those who are investing, you are getting benefit out of it. So hence, I think anytime you have money, you have surplus money, you can come in and invest in equity market through mutual fund. That is the best time for you. So we at Investsphere Wealth, we always talk about, whenever you have money, you discuss with us and we will guide you which category mutual fund you should choose, which fund you should choose, which fund manager you should choose at that particular time is the matter of fact where you should go for. It's not the timing the market. I never time the market. So if you want to avoid all these mistakes, it's not only 4 mistakes. There are a lot of mistakes investors do. I can go on talking, discussing. There are a lot of investors, they behave in different way in different time. If market is down, they behave negatively. Let's pull out the money. So that time we manage your behavior. So it is always requested. It is always advised to contact your distributor, contact your wealth manager, sit with him regularly, discuss your existing portfolio as well as the plan in the future, or maybe you discuss about your goals in future so that you understand your goals properly and then plan accordingly. So we at Investsphere Wealth, we do a financial planning activities in the very beginning of the discussion. We need to understand you, very carefully, so that we can fix one by one all the desired goals in short term, medium term and long term, so that you will not disturb your investments in very short period of time. Hence, do contact us, reach out to our team, go to our website and check out our profile in different media, and then come back and invest with us. Thank you.